And moving on, we are now going to talk about money market funds. So let's remind ourselves why money market funds became so attractive in the first place. They now account for some 40% or US $4 trillion of all cash held in the United States. That's 40% of all the cash in the United States. And this reflects a 25% rate of growth over the last 12 months. As investors have generally seen SEC registered money market funds as a safe haven, in spite of a few funds exhibiting obvious stress that has required promoter support, and the well-publicized failure of both the Reserve and the Lehman funds. However, what this overall growth disguises is a clear move by the US institutional investors away from traditional so-called prime funds to US Treasury and government-backed security money market funds, even though the yields on such funds are very low and even went negative for a short period. Now, this trend has been much less noticeable with European domicile money market funds. Although there are now a small number of euro-denominated government securities and one sterling government fund that has been recently launched. Demand for these new funds has largely been from European subsidiaries of US multinationals, and it remains to be seen whether such funds will catch on with the European institutional investors. European money market funds now account for some 420 billion euros, equivalent in the three main currencies. So European money market funds, that's about 500 billion US dollars, which is a lot compared to the US money market fund of 4 trillion US dollars. So this includes for Euro money market funds around 145 billion US dollars plus of sterling funds. Now, the last decade has seen a very rapid growth for such funds, and although there are recent signs that growth has checked among institutional investors, it seems that high net worth investors are now taking up any slack as they move out of enhanced funds that have contracted sharply or being closed down. However, not all cash funds are the same. Typically, liquidity or treasury style funds are managed to a short-dated benchmark, such as 7-day Libid, which refers to the London Interbank Bid Rate. They offer daily liquidities, carry AAA ratings, and have a constant net asset value or stable pricing. First of all, they offer diversification by issuer, instrument, and maturity, and to a greater degree than most institutions could achieve on their own. Other variants of money market funds, often called cash plus or enhanced cash funds, would typically be managed to 3-month Libor or similar. It would have 2-day or longer settlement and a variable net asset value. In other words, the daily market pricing. Such funds can carry a AAA rating, but often they are lower rated. Their attraction is that they should carry a higher yield or return because they can invest further out along the money market curve. Given different benchmark and settlement requirements, this could work. And furthermore, it can invest in a wider range of credit instruments, including derivatives and asset-backed paper. Now, all this depends on the extent to which they are enhanced. It may seem obvious now, but going forward, investors will need to decide what their priorities are from an investment perspective. Security, liquidity, and yield, these three factors should all be part and parcel of a money market fund. But there has to be a trade-off between yield and the first two, which is security and liquidity. With credit ratings agencies somewhat discredited, it is all the more important to seek out a professional manager who has the resources to carry out detailed credit analysis on names and instruments. It is also worth confirming that an offshore fund is run under the IMFA, which is the Institutional Money Market Funds Association, code of practice, as this is a useful kite mark to have. And the IMFA currently has over 20 active members and reads like a who's who for the money market fund industry. Going forward, simplicity is also going to be key. Historically, floating rate instruments, asset-backed securities, medium-term notes, and repos may have seemed ideally suited to a money market fund portfolio. That has proved costly for some, particularly as far as liquidity is concerned. For a pure liquidity fund, the only really acceptable instruments are deposits with reputable counterparties, certificates of deposits issued by solid bank names, and short-dated government-issued debt. Conventional floating rate notes or CDs may play a part in some funds, but for those with liquidity as priority, the poor secondary market in these instruments needs to be factored in. The commercial paper market, meanwhile, has all but dried up, removing it as an investable option for many funds. So that sums up the money market funds segment here. And now we're going to talk about current issues in the cash flow. Finally, a few comments about the current state of the interbank markets. Liquidity has become a huge issue, a real huge issue, amid the ongoing financial crisis. Even instruments such as CDs with well-rated banks, which would normally be completely liquid, have become difficult to trade. Indeed, the money market has even been shut at times. In the United States, the Federal Reserve has recently announced that it's now giving Rule 2A-7, Treasury style, money market funds access to the Fed window to provide them with liquidity to meet outflows, especially if these are abnormally large. The Bank of England is now committed to providing a similar facility, and the European Central Bank may do something similar. A further plan to support funds is to set up a deposit insurance scheme for retail investors, similar to that of bank deposits. As a more defensive move, in late September 2008, most funds increased their overnight liquidity in sterling. It was probably in the region of 20 to 30 billion pounds, or 30 to 45 billion US dollars. And this dislocated the interbank markets even more, exacerbating the gap between overnight rates and Libor rates. However, this exercise came at a cost to performance, especially for those funds with a higher proportion of less liquid securities, like floating rate notes and commercial paper, whose managers therefore felt that the funds they managed had to hold an even greater proportion in overnight investments at a time when overnight rates were collapsing. Sterling and euro money market funds generally seem to have weathered the storm for now, but of late the disparity between different fund performances has been much greater than usual, as has the gap against their respective fund benchmarks. And this is an area worth exploring, as it can tell you a lot about how the fund has been managed and what issues have arisen. It will be pretty interesting to see how funds cope with the recent downturn in investment rates globally. And usually funds are at their most competitive when interest rates are falling. Now, if you notice that the interest rates are falling, that's a sign that the funds are going to be more competitive. And it's clear that regulators both in the US and Europe will be reviewing whether and how money market funds should be specifically regulated. Now, you guys want to watch this space, but in the meantime, expect funds to be more conservatively managed and operated. So what do we do? What do we do about this? We got to make it happen, right? So it's important to have a clear strategy and credit procedures when it comes to your investments. And the days of do it yourself are probably numbered. Unless you can gear up to run a fully functioning professional cash desk, which I'm pretty sure that most of us do not have that sort of resources. Your bank, custodian, or financial advisor should be the first port of call. So you want to seek professional advice when it comes to dealing with your cash. Longer term cash can always be placed in segregated mandate with a specialist cash investment manager. In fact, there's now a viable choice of pooled funds, as long as you do the appropriate due diligence and get comfortable with the fund and the provider's credentials. And furthermore, treasury-style money market funds can provide professional cash management at low cost with a smooth return. and give the operational flexibility that is essential for working cash balances. These portals can offer operational advantages for the multi-fund user. So to sum it up, you do have a choice, and best practice demands careful consideration of all the available options. So you want to really do your homework when it comes to investing your cash, because it's often those impulse investments that are going to end up badly. And that's all for this chapter of investing cash. And hopefully that's helpful to you. And that's all for now. Thanks for watching, guys.